Session 9 is cost, volume, and profit analysis. The break-even point, it's an important concept, is where profits are zero. Now, break-even usually refers to accounting break-even, which again does not take into account time value of money, etc. But you just get the point that break-even generally means that profits are zero. So neither loss nor gain. Incremental profits are equal to the price minus variable cost into increase in number of units produced. So if a firm is increasing the amount of production, then the extra amount of profits which that will produce, provided price and variable cost are the same, it will be price minus variable cost into increase in number of units produced. So let's say price is 50, variable cost is 30. So price minus variable cost is 20. And suppose the firm produces 100 more units, then the extra profit will be 20 into 100, will be 2,000. And that is assuming price and variable cost don't change. Variable cost, by definition, you assume other costs which don't change, which remain proportional. And in this simpler questions that we shall do, variable cost will remain constant. And price, if the firm is in the competitive market, the price should remain constant. Now we come to the chapter on cost, volume, and profit analysis. The way I'm going to do it this time is that I'll just get on to the questions, and when I do the questions, the formulas will be used, and you can learn the formulas along the way. So here we have, because this is a lot of it's a lot of common sense. And there's not really a lot of theory, there are just some formulas, so you learn it by having them applied to questions. So here we have a firm which makes two versions of a camera, A and B. A sells for $75 and has a variable cost of $50. B sells for $90 and has a variable cost of $75. Now the question is, what is the variable contribution margin ratio? Okay, so this is the important concept in this question. The variable contribution margin is the amount by which the price exceeds variable cost. So it's variable cost, it is the price minus variable cost. The variable contribution margin ratio is the variable contribution margin divided by the price. So for the first one, for A, we are going to have the variable contribution margin to be 75 minus 50, so that's 25. And the variable contribution margin ratio, you have to divide the variable contribution margin, which is 25, by the price, so that's 75, or that ratio equal to 33.33%. For B, the variable contribution margin is going to be the price, which is 90, minus the variable cost, which is 75, so that's going to be 15. And then the ratio, you have to divide it by the price, so that's going to be 15 by 90, which is equal to 16.67%. Now, here we have a profit maximization question. So the idea in this kind of accounting is that you want these numbers, and you also want the numbers to make decisions. And the decision to be made usually is how do you maximize profit or efficiency. It's maximizing profits is efficiency. In such situations where you have production, so you want to do the most efficient production. So you have a firm, D&B, which makes daisies and bonds, and daisies sell for $50 per unit, and they need 1 labor hour, and the variable cost is $30. Bonds sell for $100 per unit, need 1.5 labor hour, and variable cost is $75. So the question is, if D&B employs 300 additional labor, what should be the increase in production? That is basically, what should it produce more of? Should it produce more of daisies or should it produce more of bonds? And so the first thing that you look at is you look at what is the incremental profit from 1 more unit of bond of daisy being produced. Well, that will be the price at which it can sell, which is 50, minus the variable cost. So the incremental profit from 1 more unit of daisy is 50 minus 30. The incremental profit from 1 more unit of bonds is $100, which is the price, minus 75, which is the variable cost. So that's 100 minus 75. So each additional unit of daisies produces $20, and each additional unit of bonds produces $25. That is not the only thing to be considered. Also, you have to account for how many more units of daisies or bonds can be produced. And for that, you have to look at how many labor hours they each need. And daisies need, to produce 1 unit, they need 1 labor hour. So if you employ an additional 300 labor hours, then how many more daisies can you produce? Well, it will be 300 divided by 1. 300 labor hours divided by 1 labor hour. Now, as for bonds, each bond requires 1.5 labor hour, and 300 labor hours extra would produce 300 divided by 1.5. So if you use that extra labor hours to produce daisies, you would have 300 more daisies, whereas if you use that to produce bonds, you would only have 200 more bonds. So then your comparison becomes 20 incremental profit per unit of daisies multiplied by 300 daisies which can be produced. So that is 6,000, or I'll write that as 6K. And here we have for bonds 25 into 200, so that's 5,000, so that's 5K. So if you use those extra labor hours to produce daisies, you are going to have an incremental profit of 6,000, whereas if you use that to produce bonds, you're going to have an incremental profit of 5,000. So you'll use those incremental labor hours to produce daisies rather than bonds. Here we have a question where you're given the contribution margin ratio, and you have to calculate the amount of sales. Now, just a bit of terminology. The contribution margin is same as variable contribution margin. So sometimes it's called contribution margin and sometimes it's called variable contribution margin. Now, what we do know is that profit is sales minus costs, and costs are fixed costs and variable costs, and that we are told is 100K, where K again stands for 1,000 kilo. So we also know that fixed costs are 40K. We are told that fixed cost is 40K. So what we have then is sales minus variable costs equal 100 plus fixed cost, or that is 140K. Now sales minus variable cost is also variable contribution margin, or aka contribution margin. So this is your contribution margin. And what is contribution margin ratio? Well, contribution margin ratio is contribution margin divided by sales. So we will have 140 divided by sales equal to contribution margin ratio, and that we are told is 35%. So sales will be 140 divided by 35%, or divided by 0.35, which will give us sales equal to 400,000, 400K. Audio check, video check, take. Here we have a question with break-even sales given to be 20,000 units priced at $10 each. So what does break-even sales means? Well, break-even sales is where profits are zero. And so if profits are zero, it means that sales minus variable costs minus fixed costs equal to zero, or fixed costs equal sales minus variable costs. And what is sales minus variable costs also known as? Well, it's also known as contribution margin. And the contribution margin ratio, there should be a ratio here, is 40%. So we want to determine what the variable costs are. So first what we are going to do is, first we are going to find fixed costs. And we can find fixed costs because we know that sales minus variable cost, which equals contribution margin, you divide that by 0.40, and that will equal sales, which is 200K. Now, how did I get this? Well, it's actually this divided by sales equals 0.40. Sales minus variable cost divided by sales equals 0.40. That's what you're given. The contribution margin ratio is 40%. And sales minus variable cost is also equal to fixed costs. So you get fixed costs, you get sales divided by fixed costs is 0.40, or you take this on this side and this on this side, and then you end up getting fixed cost divided by 0.40 equal to 200K, or fixed costs equal to 80K. Now, essentially, what we have here is sales minus variable costs by sales equal to contribution margin ratio, and that was equal to 0.40. So you bring sales to this side and you take this to this side, you get sales minus variable cost divided by 0.40 equal to sales, and sales minus variable cost equal to fixed cost, and that's what you use to find that fixed costs are 80K. Now variable costs equal sales minus fixed costs when profit is 0, because you take variable cost on this side, so sales minus fixed cost minus variable cost equal to 0. So variable cost equals sales minus fixed cost when profits are 0, which is the break-even situation. Break-even sales, we are given information for break-even sales. So then variable cost would become sales, which are 200K, minus fixed cost, which is 80K, or that would be equal to 120K. In the next question, we have to find the weighted average contribution margin. And the weighted average contribution margin is defined as the, there are two versions here. There's a version D and there's a version E. And the weighted average contribution margin is defined as the contribution margin for D multiplied by number of units of D plus the contribution margin for E into the number of units of E whole divided by the number of units of D and E. So that will equal, what's the contribution margin for D? Well, the contribution margin for D is the price of D, which is 50 minus the variable cost, which is 20. So that's 50 minus 20 is 30. So this is the contribution margin for D multiplied by units of D. And how many units of D are sold? Well, 30 units of D are sold, plus the contribution margin of E, which is going to be the price of E 40 minus the variable cost 10. So that's going to be 30 also, multiplied by the number of units of E, and 50 units of E are sold. So this is contribution margin of D multiplied by number of units of D plus contribution margin of E into number of units of E whole divided by number of units of D and E. So that is going to be 30 plus 50, and this you can see is going to be 900 plus 1500 equal to 2400. 2400 divided by 30 plus 50 is 80, or this is going to be 30. So this is the weighted average contribution margin. Here we have a question for calculating the contribution margin per unit. So the contribution margin per unit would be the price per unit minus the variable cost per unit. And the per unit price is 90. And the variable cost is given as 50. So price per unit minus variable cost per unit gives you the contribution margin per unit, and that is 40. In this question, we are asked to calculate variable cost per unit using account analysis. Well, in account analysis, we are looking at which of these expenses are actually variable and which are fixed. So the expenses that we have are raw materials, direct labor, rent, depreciation, and business license. Of these expenses, only direct labor and raw materials are variable. So direct labor is the labor that is being directly used in the manufacture of the good, and then we are going to have raw materials of 8,000 plus labor, direct labor of 3,000, so that's 11,000 is the total variable cost. And you divide that to get per unit, you divide that by the number of units, which is 500. So that is equal to 22, and that is the per unit variable cost. Here we have a question in which the variable cost per unit and fixed costs are to be calculated using the high-low method. In the high-low method, what you do is you look at the highest production and the lowest production, and you use those numbers to calculate the difference in production and cost, and then you take the ratio to decide to find the variable cost. So here the highest production is 3,200, which had a cost of 75,000, so it's 75K. The lowest production is 2,200. So the difference in cost is 75 minus 60, and that you divide by the difference in production, and the difference in production is 1,000, so that's 1K. So this becomes equal to 75,000 minus 60,000 divided by 1,000, which is equal to 15. So the variable cost is 15 per unit, and then you can find the fixed cost as the variable cost multiplied by the production, and you subtract that from the total cost. So variable cost into production will give you total variable cost, which is 15 into 2,200 will be 33K, 33,000. And then you subtract that 33,000 from the 60,000, so your fixed cost is going to be 27,000. You could even subtract the variable cost, total variable cost for this February production. You would multiply 3,200 by 15, and you would get 48,000. So that 48,000 you subtract from the total cost of 75,000, and you'll still get 27,000 as the fixed cost. Remember that the fixed cost plus the variable cost equal the total cost, which is what is given here. So this is the column for total cost. Here you have a question where you have to calculate the break-even point. Now, break-even point is the point where profits are zero. And profits being zero means that sales minus total variable cost minus total fixed cost equals 0, or fixed costs equal sales minus variable costs. Total fixed cost equals sales minus total variable costs. Now, the variable cost per unit, not the total variable cost, but the variable cost per unit is given as 30, and the price per unit is given as 80. So what is sales? Well, sales equal price per unit P, which is 30, price per unit is 80, into the number of units sold, so let's call that N, minus total variable cost is variable cost per unit, which is 30, multiplied by number of units sold, that is N. Now remember, variable cost is constant as you change quantity. That's the nature of variable cost per unit. It's constant as you change quantity. So to find total variable cost, you can just use the variable cost per unit and multiply it by the number of units. And so this is equal to 50, 80 into N minus 30 into N is equal to 50 into N. So you're at the break-even point where total fixed cost equals sales minus total variable costs. You're going to have fixed cost, which is given as 2 million, equal to 50 into the number of units sold, or N will be 2 million divided by 50, and that will equal 40,000. So the number of units to be sold equals 40K. Here we have another question about profit maximization, which is again cost related. We have a firm which sells bicycles at a price of 249 per unit, and the fixed cost total 112,000, and the variable cost per unit is 134. Now the firm can purchase new equipment which will reduce the variable cost to 114 per unit, and however this new unit will make fixed cost increase to 152. So the question is, what is the minimum number of units which the firm must sell to make this a good purchase, to justify the purchase of this equipment? So let us say that the number of units which the firm sells is V. So savings by this new equipment will be equal to the old variable cost of 134 minus the new variable cost of 114 into V, where V is the number of units, volume. So what about the increase in fixed costs? Or that is equal to 20V. Now, fixed costs have increased from 112 to 152, so they have increased by 40K. So fixed costs have increased from 1 to 152 from 112, and that's an increase of 40K. So the savings must at least equal the increase in fixed costs to justify the decision, or 20V must equal at least 40,000, or the minimum amount of V that you need is 40K divided by 20, which is equal to 2000. So the minimum volume which the firm must sell to justify this new equipment is 2000. Here we have a firm which produces 3 different models, and we have to find what is the increase in profit if it increases sales while the product mix remains the same. So if you look at these numbers, we are given the 3 models AQ, QD, and AD, and these are the sales, current sales, and these are the variable costs. Now, if you look at the contribution margin for these different models, now this is going to be 50 minus 20, or that's going to be 30K. This is going to be 70 minus 35, that's 35K. And this is 80 minus 50, which is again 30K. So the total contribution margin is 95, and sales are going to increase by 20K. So what is total sales now? Well, total sales right now is 50 plus 70 plus 80. So total sales are 200,000. So total sales are 200K, and it's going to increase by 20K, so it's going to increase by 10%. Now, what do you think is going to happen to the contribution margin as if the product mix remains the same? Well, the contribution margin is also going to increase by 10%. So, from this total of 95K, this is going to increase by 9.5K. Now, what was the profit? Well, we don't know what the profit was, because we know that sales minus variable cost equal to 95K, but we don't know what the fixed costs are, so we don't know what the profit is. We know that it is 95,000 minus fixed costs, but we don't know what fixed costs are. However, because of the increase in sales, we can find the increase in profits. Why can we find the increase in profits? Well, the increase in profits is new profits minus old profits, and both of them have fixed cost in it. The fixed cost cancels out. So the fixed cost does not matter for the increase in profits. If you're looking at the change in profits, then fixed cost doesn't matter, because to get the old profits, you're subtracting fixed cost. To find the new profit, you're also subtracting fixed cost. So the change in profits is simply the change in contribution margin, and that is 9.5K. Now, if I was to write out the equations, then I would say that the new sales is 220K. That's because it has increased by 220K from the initial 200K, minus the new variable cost is, now if sales increase by 10%, then variable costs will also increase by 10%, because variable costs are proportional, the total variable costs are proportional to the amount of output. So this is going to increase from 20 plus 35 plus 50, that's 105, to 105 plus 10%, so that's going to be 115.5. minus fixed costs. So this is the new level of profits. Now what is the old level of profits? Well, the old level of profits was old level of sales, which was 200 minus old level of total variable cost, which was 105 minus fixed costs, and so this is the old level of profits, and this is the new level of profits. So you want to find the change in profits. You subtract this from this. Now fixed costs and fixed costs cancel out, and what you have left is 220 minus 200k and 115 minus 105k. So that will equal, this will be 20 minus 10.5, or that will equal 9.5k. So this is if you write out what the new level of profit will be and what the old level of profit was. You just, the fixed costs cancel out, so you can calculate it. Even though you can't calculate this or this separately because you don't know what fixed cost is. Here we have another question on profit maximization, and this firm produces two models, CC and CX, and each model has a demand of 10,000 units. Now the prices are given as 30 and 40, and the variable costs are 20 and 22. Labor required is 0.2 for the first model and 0.3 for the second model. The firm has a total of 4,000 hours of labor available, and the question is, what should be its product mix? Now when you look at this question, what is firstly the constraint? What is the bottleneck? The bottleneck is amount of labor available. Because it's not, if it had a infinite amount of labor available, then assuming each product made a profit, the correct thing to do would have been to produce the maximum of each product, which would be 10K. Because after 10K, the firm can't sell it, so no point in producing it. So it must be, what you have to check is that if there's enough labor available to produce 10K of each, then that's the answer. Because the prices, you can see that each one of them is going to has a positive contribution margin. And so the more, because the price for the first one is 30, whereas the variable cost is only 20. So every more unit of the first one you produce, you get 30 minus 20, that's $10 more. And for the more unit of the second one that you produce, you get 40 minus 22, which is $18 more. So you want to produce as much as possible. However, this must be the bottleneck. And if this is not the bottleneck, if labor is not the bottleneck, then you should obviously produce 10,000 of each unit, which is the maximum demand, because the firm can't sell more than 10,000. So we are going to find out how much it can produce. Okay. Now, so it takes 0.2 labor hours to produce 1 unit of the first model and 0.3 labor hours to produce 1 unit of the second model. So to produce 10,000 units, it would require 2,000 hours of labor for the first model, and it will require 3,000 hours of labor, that's 0.3 into 10,000 for the second model. So if you are producing 10,000 of each model, you would require 2 and 3 or 5,000 hours. However, the amount of hours you have is only 4,000. So you can't really produce the maximum demand for each model. And so you're going to produce one, the most you can, to the maximum demand of 10. And after that, whatever is left, you're going to use those labor hours to produce the second one. So what we would like to know now is, for each labor hour that is being used, how much profit do we get for the first model and for the second model? Okay, now the first model requires 0.2. So for each hour, each labor hour produces 0.2. So each unit requires 0.2, or then each labor hour will produce 1 divided by 0.2, that's 5 units. So if each produces 5 units, then what is the profit which is produced by spending 1 labor hour on producing the first unit? Well, it will be the profit per unit for the first unit, which is 10, and 5 units are produced, so it will be 50. So CC produces a profit of $50 per labor hour. Now, what about the second one? Now the second one requires 0.3 hours to produce 1 unit. So number of units that you can produce of CX with 1 labor hour, number of units you can produce is 1 divided by 0.3. And what is the profit per unit? Well, the profit per unit is 40 minus 22, the price minus the variable cost, 40 minus 22, and that is equal to 18, or what you have here then is 60. So every labor hour which is spent on producing CX produces $60 per labor hour. I'm actually ignoring fixed costs over here because what we are just trying to do is we are maximizing the contribution margin. We are maximizing the revenues minus variable costs, because fixed costs being fixed don't change as we change the product mix, and therefore do not need to be considered here. Of course, the actual amount of profit will depend on fixed costs. However, we are just trying to decide like what product mix to use, and that fixed cost will not play a role there, because as we change the product mix, the fixed cost does not change. So for deciding which particular product mix to manufacture, deciding between different product mixes, we can ignore fixed costs because all the different product mixes will have the same fixed cost. So each labor hour spent in producing CX produces a $60 contribution margin, has a $60 contribution margin, whereas each spent producing CC has a $50 contribution margin. And therefore, we should rather be spending the labor producing CX rather than CC. So should we use the entire labor to produce CX? And the answer is no, Because if you use the entire labor to produce Cx, how many units are you going to produce? You're going to produce 4,000 divided by 0.3, which is going to be about more than 12,000. And the maximum demand is only, it's actually going to be like 13,333. But the maximum demand is only 10,000. So you can only sell 10,000. So you're not going to produce 13,000 when you can only sell 10,000. So you will only use enough labor to produce 10,000 units. And the amount of labor that you need to produce 10,000 units will be 10,000 divided into 0.3 or 3K. So 3K labor units for producing Cx. How much does that leave? That leaves 1K. And you're going to use that to produce Cc, because production of Cc is a good thing. It produces $50 per labor hour of contribution margin. It is just not as good a thing as production of Cx, but you're producing the maximum Cx by consuming 3,000 labor hours for Cx, and that leaves you 1,000 labor hours still free, and you're going to use that to produce Cc. So 1K for Cc. So 3K for Cx is going to produce 10,000 units of Cx. 1K for Cc is going to produce 1K divided by 0.2 or 5,000 units of Cc. So your final product mix is going to be Cx equal to 10K and Cc equal to 5K.